Hey, come see us on tour. We'll be in Tempe, Arizona, Burbank, California, and we're going to be in Honolulu, January 11th. Go to jimmydore.com for a link for tickets. Hey, so they cut interest rates finally. First time in a long time. And on here to talk is our good friend Paul Stone, co-founder and CEO of Colonial Metals Group, which is an advertiser on this show. It's a Florida-based precious metal supplier that helps clients develop secure retirement plans by investing in gold and silver. His writings appear at his Substack, thepaulstone.substack.com. Please welcome back to the show, Paul Stone. Hey, Paul.
Hey, Jimmy. Great to be back. Thanks for having me. Hello, everyone, to the Jimmy Dore family.
So it's good to see you. I want to play this, and I want to get your feedback on it. Let me play this. This was the big news.
50 basis point rate cut. The Federal Reserve slashing its benchmark interest rate by a 0.5 percentage point to a new range of 4.75% to 5%, marking the first rate cut in more than 4 years. Now, Fed officials see 2 more 25 basis point rate cuts this year, followed by 4 more cuts next year and 2 more cuts in 2026. Breaking down what officials saw, 9 officials saw 4 cuts this year, so that includes the 50 basis point rate cut today. 7 saw 3 cuts. 2 officials saw 2 cuts this year, and 1 saw 5 cuts. Now, officials say in their statement they are gaining confidence that inflation is moving sustainably back down to 2%, saying, removing the word some, and now saying instead that inflation has made, quote, further progress towards the Fed's 2% goal. The statement also reading that, quote, the committee has gained greater confidence inflation is moving sustainably towards 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. Now, future rate cuts will depend on the evolving economic outlook as well as the incoming data and the balance of risks. The outlook for interest rate projections come as Fed officials now see the unemployment rate rising to 4.4% this year and holding at that level over the next couple of years. That's up from 4% previously forecast. At the same time, economic growth is seen at 2% this year instead of 2.1% previously forecast. And officials expect the economy to coast at that 2% level over the next couple of years. As for inflation, they moved down their inflation outlook. They now see inflation ending the year at 2.6%. That's down from 2.8% previously, and then moving down to 2.2% over the next year. Now, there was some division on today's decision. It was a split vote. It was not unanimous. Fed Governor Michelle Bowman dissented, saying that she would have preferred to have cut rates by 25 basis points instead of 50. This marks the first dissent in 2 years. Back to you.
Okay, so here, before I go to you, Paul, let me just say, so there's this, I saw this interview with this guy, Joseph Wang, and he's got a whole shit ton of followers. And here's what he said that he was afraid of about this rate cut. Here's what he said.
Yeah, it was different for sure. I would say that in the grand scheme of things, 25 basis points, 50 basis points really doesn't make that much difference, especially since most of the policy is transmitted not from the spot Fed funds rate, but from the implied path of policy. So basically watching what the 10-year would do, since that's what a lot of things are keyed off of. Mortgages, for example, largely keyed off of the 10-year treasury. So, I wonder if this moment, just this degree of uncertainty, just whether or not reflects 2 things. One is just I think the difference in understanding what the post-pandemic economy looks like when it comes to the neutral rate. So not knowing just how restrictive or loose policy is. And secondly, just how you weigh that mandate of full employment and price stability. I imagine that the FOMC today is more sensitive to full employment than inflation, simply because of the change in the composition. So maybe that is also playing into, I think, more of a struggle to come together to have a consensus decision.
Absolutely. And you bring up the spot Fed funds rate. I mean, for the longest time, we were almost exclusively focused on the forecast because, as you rightly note, the outcome on the rate decision was a foregone conclusion. What did the Fed signal in terms of their forecasts for the rest of this year and then going forward?
I looked at the dot plot. It sounds like they're signaling a recession. What jumped out to me is that they revised upwards their unemployment rate forecast from 4% to 4.4%, and that is higher than their forecast of the long run unemployment rate. So if you have if you're forecasting a continuing uptick for the unemployment rate, not just the next few years, but basically throughout next year, that suggests some slowing in the economy that could potentially be a recession. So, of course, the Fed is never going to come out and say, we think that we're going to be in a recession, guys, prepare accordingly, because there's so much of that confidence game. But I think that's what they're thinking. And so that's part of the reason why they cut more aggressively this time and are forecast to cut another 50 basis points by the end of this year.
So according to this guy, Paul, he says that what the real signal is that they think there's going to be a recession. But of course, they can't come out and say that. So what do you make of this?
That's what I make of it. I make of there's look, the trouble's not, to me, and not a financial advisor, not a trained economist, but someone who studied this to understand it, because it was very confusing to me long time ago. And now I feel like I have at least a farmer's grip on things. And that is that the trouble can't go away. The money printing can't stop. It can't stop. So one place where he was talking earlier at a macro viewpoint on, where do interest rates really get determined, and that's when you're signing for a loan. The Fed pays $1.1 trillion a year in interest payments on the debt. When they reduce rates, let's say they just cut rates in half, then they would spend $500 million a year on interest payments on the debt. So it saves them money. But the money printing can't stop. So when you look at what's causing so much of the trouble, it's that we never got the corrective measure from a recession to reset things within the economy, because politically it's just too crazy to allow such a thing to happen, regardless of what party's in power. So it gets pushed off and pushed on down the road until that recession comes through the door, whether you like it or not, and there is no more printing money to keep it from happening. Cutting rates has always been historically a sign, or an action, I should say, forget that word. It's an action to head off or juice the economy as it's going through a recession. They were much harder to detect for the brainiacs in Washington at the Federal Reserve. It would happen so regularly, and there's so many things that trigger before a recession, and they're all triggered. They've been triggered since 2018. I won't go through the boring list of them, but picture at least 12 different economic indicators that trigger before a recession and can only show up if you're headed towards one because of the math. They've been triggered since 2018.
Okay. Yeah. All right. Yeah. So the Fed is supposed to do two things, right? The Fed is supposed to control the interest rates, and they're also supposed to control employment. Is that what am I getting those wrong?
No. Good. That's good analysis. Their job is to maintain moderate growth without any overheating or any nosedives into the ground. And so if they see an typically what it would always cause, and to put this one in your hat for a minute, everyone who's listening, the real thing that would generally cause an economy to overheat is full employment, because everyone's working. Now everyone has extra money. Companies are fighting to keep their workers from leaving for more lucrative offers at other companies, because what are companies trying to do? Grow. So to grow, they get more, they make more, get more folks working, make more stuff, sell more stuff, earn more money, hire more workers, make more stuff. On it goes until you run out of workers. You run out of workers, then you're going to pay, company B, the workers there, to come over to your company and pay them more than what they're currently earning, right? So generally workers have incredible wage growth at the end of an economic expansionary period, a bull market. And they're out buying bass boats and all kinds of trips and all kinds of extras they couldn't usually buy at their moderate income levels. But now that the economy's running out of workers, they're scraping the bottom of the barrel for workers, they're getting paid a lot more. So when that part of the economy overheats, the Fed starts cranking up rates. And what does that do historically? It gets those people fired, because now your economy slows down, the companies can't sell as much, we can't buy as much, and the company then sheds workforce and sends those folks to their couches waiting for them to be hired back. And that lack now killing of consumption causes inflation to come down. So that's generally how they seek to moderate growth. When it gets too hot, they cool it down with raising rates. And when it gets too cold, they lower rates to juice it back up. So if they're lowering rates, they have to.
So
that's not a good sign.
The way the Fed fights inflation is it puts people out of work, and the way it puts people out of work is it raises interest rates, which makes money tighter and harder to come by. And so they do that on purpose. It's just the craziest thing to me, but that's how this capitalism works. And so now they say, So now they're forecasting 4.4% unemployment. But we know that's not the real unemployment because, as you've taught us on this show and other people have talked about on the show, they don't count unemployment the way they used to count unemployment in the 80s. They count it way differently. And if they count it correctly, it would be somewhere over 10%. Some people say 15. You say upwards of 20%.
I'm just using the old-fashioned way of counting. It's not my number. It's the number that was used for hundreds of years to count unemployment. Says the number is 25%.
And let's remember that during the Great Depression, the unemployment rate was 25%.
Yeah.
And so that's why I think, you hear all these rosy forecasts about the economy and people talking nicely about the economy, but they use this phony unemployment number. We're really living through something. I see people hurting all over the place. People without enough money to afford their groceries, which have doubled, and their housing prices, which have doubled since 2010. Their salaries haven't doubled. Right, we're going to talk about that. Right, we're going to talk about that in a second. But so that's the news is they've cut 0.5% off the interest rate. And according to that news report I played from Yahoo, they're going to cut it like 6 more times going forward. That's the plan anyway. Yeah. And why would they be wanting to do that? Because they see the economy slowing down. They see us going into a recession, as this guy just said. They see us going into a recession, so they're going to start cutting. And by the way, it wasn't unanimous. Hey, I believe in having a substantial percentage of my financial future, meaning my retirement fund, secured with gold and silver. You know that. You know what I think about what's going to happen with the stock market. And that's why I decided to partner up with Colonial Metals Group. They helped me set up a safe and secure self-directed IRA where I have access to my assets no matter what the stock market, or for that matter, what the government is doing. Let the team of experts at Colonial Metals Group help you protect your family's future. We've put together a special offer for our audience. Click on the link in the description below or call a special 800 number and you're going to receive a safe and up to 10 grand in free silver. That's real. That could happen. Find out how that could happen. Go to colonialmetalsgroup.com/Jimmy-Dore-show. So colonialmetalsgroup.com/Jimmy-Dore-show or call 888-910-1419. Hey, come see us on tour. We'll be in Tempe, Arizona, Burbank, California, and we're going to be in Honolulu, January 11th. Go to jimmydore.com for a link for tickets.